In January 2020, you could buy 1 ounce of gold for $1,700. Today, that same ounce costs over $4,700. That is not a typo. That is a 177% return in 5 years on the asset that your grandfather was told was boring, old-fashioned, and going nowhere. And here's what makes this moment different from every other gold rally in recent history. This time, the buyers aren't panicking retail investors. They're governments, they're central banks, they're the most sophisticated financial institutions on Earth. So, today, we're going to break down exactly what is driving gold to these levels, and what it means for your money right now. Let's start with the scale of what's actually happening. Gold is up 41% in the last 12 months alone. To put that in dollar terms, if you had $50,000 in gold this time last year, you'd have over $70,000 today. If you had $100,000, you'd be sitting at $141,000. Meanwhile, the average savings account is paying somewhere between 4 and 5%, and losing ground to real inflation every single day. But the number isn't just impressive, it's a signal. Gold doesn't move like this without a reason, and there are 3 very specific reasons driving this rally, and not one of them is going away anytime soon. The story starts with central banks. In the past 2 years, central banks have more than doubled their gold purchases compared to historical averages. China has been buying gold for 18 consecutive months. India has been quietly adding to its reserves at the fastest pace in decades. Turkey, Poland, and several Eastern European nations have made gold a core pillar of their national reserve strategy. Why? Because these governments are looking at the United States' $34 trillion in national debt, looking at the dollar's declining share of global reserves, down from 60% to 25%, and making a very clear decision. They want their wealth stored in something that no government can print. When the biggest buyers in the world shift their strategy, prices respond. And that's exactly what you're watching happen in real time. Here's something the mainstream financial media barely covered, but that gold traders paid very close attention to. Gold spent the last 12 years consolidating in a range. Analysts call this building a base, and in early 2024, gold broke out of that 12-year base decisively. On an inflation-adjusted basis, it broke out of a base that had been forming for 40 years. When a major asset breaks out of a decades-long consolidation, momentum traders notice. Institutional money notices. Funds that weren't permitted to touch gold while it was range-bound suddenly have internal permission to buy. And that flood of new institutional capital is part of what has driven this 41% move in just 12 months. The breakout doesn't guarantee where the price goes next, but it does tell you that the character of this market has fundamentally changed. On top of the structural story, 3 very specific catalysts are driving gold higher right now. First, tariffs. When governments impose trade walls, supply chains break down, inflation rises, and investors flee to assets that hold value regardless of political decisions. Gold has been the direct beneficiary of every major tariff escalation in the past 2 years. Second, dollar weakness. The U.S. dollar index has declined steadily. A weaker dollar makes gold cheaper for foreign buyers, increasing global demand. And it signals to domestic investors that their purchasing power is eroding, making real assets more attractive. Third, geopolitics. From the Russia-Ukraine war to Middle East tensions to the U.S.-China standoff, the world is more geopolitically fragmented than at any point since the Cold War. Gold has been the universal hedge against geopolitical uncertainty for 5,000 years. That's not changing. All 3 of these catalysts remain fully active. None of them are going away, and that is why serious analysts aren't calling a top. They're calling for $5,000. So, what do you actually do with this information? If gold hits $5,000, which would be roughly a 6% move from current levels, investors who position today would be sitting on a gain in weeks or months. But the more important point is the long game. Gold doesn't have to hit $5,000 next month to be the most important portfolio decision you make this year. The argument for gold isn't a short-term trade. It's a structural shift in how global wealth is being stored, and that shift plays out over years, not days. Most financial advisors now recommend a 5 to 15% allocation to gold in a diversified portfolio. There are multiple ways to get there. Physical gold coins or bars, gold ETFs like GLD or IAU, which are low cost and highly liquid, or gold mining stocks which give you leveraged exposure to the metal's price moves. The question isn't whether you believe gold will hit $5,000. The question is whether you want to be positioned before the next $500 move, or explain to yourself afterward why you were watching from the sidelines. Gold is not a panic buy. It is not a doomsday bet. It's what happens when the smartest money in the world decides that paper promises aren't good enough anymore. If this video helped you understand why gold is moving the way it is, and what to do about it, subscribe. Because next week, we're talking about the metal that's already outperforming gold this year, and most people have never even considered owning it.